Assalamu alaikum. Welcome to question number 23 of SBR revision kit. Tiles. Okay. So we have the background and then we have the deferred tax asset. That means we have to use IAS 12 here. Okay. Then we have discontinued operation, which is IFRS 5. We have disclosure of bonuses. Okay. Required. Explain how the above transaction should be dealt with the financial statements for the year ended 30th April 2005 and discuss the ethical issues raised 18 marks and 2 professional marks. This 2 professional marks is only for the ethical principles. It is not for the accounting issues. Question number 8, first requirement. This is the only requirement. 18 marks, and here they didn't separate the marks. Usually they give here on the right side 3 marks like this. They will be giving you the marks, but here they didn't give the marks. They just gave you the total marks, 18 marks, and now you have to allocate these marks equally among the 3 issues as well as the ethical issues, because we have accounting issues as well as ethical issues and also 3 issues: discontinued operation, deferred tax asset, and disclosure bonuses. So if I have to divide this 18 marks equally, it would be 6, 6, 6. But this 6 are for this 6 compromises both ethical as well as accounting. So you just divide this further. 3 for accounting, 3 for ethical, 3 for accounting, 3 for ethical, 3 for accounting, 3 for ethical. Like that, I will add up to 18. Okay, this 2 only for ethics. Okay, it is separate from this 18 marks. So now let's read the background first, because I always start by reading the background first. TAS is a publicly limited company that prepares its financial statements in accordance with IFRS. Results over the past 5 years have been disappointing. This is very important from the point of accounting issue as well as ethical issue. Okay, and this has caused many of the largest shareholders to become increasingly disgruntled. At the latest shareholder meeting, the board of directors was criticized for being slow to react to changing economic circumstances and for being overpaid. The shareholders told the directors that they expect to see substantial improvements in recurring profit for the year ended 30th April 2005. Deferred tax asset. Now guys, you have an option that you can either read all the 3 issues and then answer question, the whole requirement, or you can read one by one and then answer. What I follow the second strategy, because I feel that the less I read whatever is specific to that, I will remember it better and I will be able to finish it faster. But again, it's your choice. I usually don't read the whole paragraph, the whole scenario. I just read whatever is specific for that requirement. I answer that. Again, I come back to my requirements and then I read it. So for example, I'm only going to read this part now. Deferred tax asset. I'm going to answer the accounting issue. Ethical issues, I always keep it till the end. Okay, ethical issues needs to be answered at the end, because you need the help of the whole case study to answer ethical issues, as well as you have to link it to the background. Okay, this question is very similar to question number 22. Okay, the only thing is accounting issues are different. Okay, so let us read the deferred tax asset. Titles incur substantial losses. Very important when it comes to deferred tax asset, the word losses. So they incurred losses in the financial years from this to this. In the financial year to 30th April 2005, it made a small profit before tax due to non-operating gains. In the financial statements for the year ended, TILE has recognized a material deferred tax asset in respect of its unused trading losses. This was based on the budgets for 2006 to 9. The finance director instructed the financial controller to include high growth rates in this budget due to positive indications from the customers about the future orders, as well as TILE's plans to expand into new market and to sell to new product currently under development. This tax losses expires in 2009. So whenever deferred tax asset is given to you, these 2 or 3 things will always be given in the scenario. Number 1, they will give a time period that they have budgeted the profit to be like this and all in the future. Then they will give you in the past what is the losses or the profit. Definitely you'll be having some losses only, that you need to recognize it. You need to bring it forward. Okay. So all these things will help you to decide whether you have to recognize deferred tax asset or not. Because remember, more than deferred tax liability, deferred tax asset are more stricter. Okay, rules are more strict on deferred tax asset, recognition of it. That's why this area is asked more compared to deferred tax liability. Okay. So now let's answer deferred tax asset. I'm not reading the other two, discontinued operations and disclosure bonus, because I don't want to confuse myself with too much of information. Okay, but if you have the time, if you want to read the whole and then answer the whole requirement, that also you can do. Okay, coming to the deferred tax asset. So three accounting issues use subheadings deferred tax asset. Okay, so when you're answering this, these are the three ways you need to do. First, state the rule of the deferred tax asset. That how can you recognize deferred tax asset under IS 12. Then you say what is the correct treatment that should be done, and then you discuss what is the incorrect treatment that has been done here and what could be the impact of this on the financial statements. Okay, for all the three accounting issues you need to answer in this manner, this order. So now you start defining deferred tax asset. This should be recognized when this is recognized for deductible temporary difference. This word has to be there in your answer. There is no shortcut for this words. Okay, maybe the sentences you form, the way you write might be different, but this word has to be there. Deductible temporary difference, deferred tax asset, loss. So deferred tax asset can be recognized for deductible temporary differences, unused tax losses, unused tax credits to the extent. Okay, unused tax losses to the extent that it is probable that the taxable profit will be available against which the deductible temporary difference can be utilized. How are you going to utilize those losses? You need the taxable profit in the future, and there's a probability, there are chances that in the future you're going to have this taxable profit. Then up to that extent only you can utilize. Otherwise you cannot recognize deferred tax asset. So now according to IS 12, the existence of unused tax losses is strong evidence. Talk about losses and all. In this case, unused tax losses is a strong evidence because they didn't use that tax losses. There was losses that needs to be brought forward. What does it mean? It's a strong evidence that future taxable profit may not be available. If you see, this answer is often repeated. The same thing is often repeated. This question is asked repeatedly. So this shows the importance of deferred tax asset, that you need to learn this. Okay. Future tax may not be available against which to offset the losses. Therefore, when an entity has a history of recent losses, here also it has losses, right? This entity, they have to recognize deferred tax asset arising from unused tax losses only to the extent that the entity has sufficient taxable profit. Otherwise, no. Taxable temporary difference. That means taxable profit. Or there's a convincing other evidence. If it's not the sufficient taxable temporary difference, then what? Then evidence has to be convincing that you are going to have soon the sufficient taxable profit. So according to this case, we'll see the second thing. Definitely we don't have a sufficient taxable temporary difference, but we'll see the evidences whether we have or not. Convincing evidences, okay? So now, refer to the company, refer it. So has Style has a history of what? Recent losses. It needs to provide the convincing other evidence now. The sufficient taxable profit would be available against which the unused tax losses could be offset. So the improved performance in 2005. Can it be an indication? Can it be other evidence that suppose that they can recognize deferred tax asset? But this is very small, and also it is based on some assumptions which might not be accurate, right? So the improved performance would not be indicative of future good performance. It's not a indication that in future your performance will improve. Okay, why? Because it is on non-operating gains. It is not something from which is not daily or not operating gain, not from your trading business. So as Styles would have suffered a net loss before tax if had it not been for the non-operating gains. So now we have to talk more about the anticipation and all. Because it is based on some assumptions, we have to talk about those assumptions in the answer when it comes to deferred tax asset. This is so Styles' anticipation of improved future trading could not alone be regarded as meeting their requirement of strong evidence. You see, even though they are anticipating that in the future conditions will improve, future trading will improve. That alone cannot be used as a strong evidence that there will be a profit in the future. So when assessing the use of carry forward tax losses, weight should be given to revenues from existing orders. When you want to carry forward the tax loss, what should you see? What are the revenues from the existing orders or confirmed contracts? Because then you are confirmed, no, that this is the revenue income you're going to have if it's from the existing order, not something that will be in the future. Because in the future, no one guarantees you. Anything can happen. You might not, get that contract. You might not that cash. You might not get that cash from your customer. So anything can happen. So it should be existing revenue from existing order as well as confirm contract, rather than those that are mainly expected from improved trading. What's happening at this date that you need to write. So thus at this date it is unlikely that the entity would generate what? Taxable profit before the unused tax losses expires. So Thile is not able to provide convincing evidence. Also, he's not able to provide convincing evidence also that sufficient taxable profit would be generated against which unused tax losses could be offset. And so the recognition of finally, in one line you are giving the conclusion. Recognition of deferred tax asset is not in accordance with IAS 12. Now we are coming to the next issue, discontinued operation. On 1st of January 2004, the shareholders had a general meeting of the company authorized the directors of Tiles to sell all of its holdings of shares in a subsidiary within a year. Within a year. Number one, sale is taking place, and also authorization of directors. They have given that authorized to sell. Okay, so Tiles had shown in the subsidiary as an asset held for sale and presented it as a discontinued operation in the financial statements. For both this and this year, Tiles made certain organizational changes during the year to 30th April 2005, which resulted in additional activities being transferred to the subsidiary. This subsidiary made a significant loss in both 2004 as well as 2005 with standard IFRS 5. And certain conditions need to be satisfied also to say it's a discontinued operation. You just cannot write anything as a discontinued operation, okay? So remember, a subsidiary is what? It is a group of assets and liabilities, and so it is a disposal group. Okay? Subsidiary has assets and liabilities, group of assets and liabilities. So it could be, it can be called as a disposal group, right? Start your answer to this issue by outlining the definition. You have to outline the definition of a discontinued operation. You have to ask, start your answer like this. And also the criteria in IFRS 5. When the disposal group can be classified as a held for sale, that means when the subsidiary can be classified as held for sale, there are some certain criteria that needs to be met according to IFRS 5. If it's met, then okay, you can say it's a discontinued operation. So first let's define what is discontinued operation. First paragraph, first line. It is a component of an entity that has been sold. It's a part of an entity, not the entire entity, but part of an entity that has been sold. For example, you're selling a branch, or you're selling a division in your company, or you're selling a company in a certain geographical location. It's just a part of that entity that has been sold or which has been classified as held for sale. It is not yet sold, but it has been classified as held for sale. You are going to sell it within 12 months. That is known as a discontinued operation. So now we are going in detail to IFRS 5. Because it should meet the criteria of IFRS 5. No? So now we're explaining according to IFRS 5, an asset or it could be a disposal group is classified as held for sale, where its carrying amount will be recovered principally through sale rather than continuing use. Okay. So when you're selling it, you will recover the carrying amount of that asset or a disposal group rather than using it. Using that asset or disposal group. Then you can say it is classified as held for sale. But remember, to be classified as held for sale criteria. Now you are giving the criteria in this paragraph. So to be classified as held for sale, number one should be sale should be highly probable. Okay, number one condition. And second, also expected to be completed within 1 year from the date of classification. Number two. Number three, there are so many conditions. Okay, asset or disposal group should be available in the sale in its immediate location and condition. Whatever condition it is, it should be available for immediately you should be able to sell it. Okay, in whatever condition and location it is. So that is number three. Point number four, actively marketed. That also at a price reasonable in relation to its fair value. It should not be below or it should not be above the fair value. Number four. So looking at this, you have to refer your case study. Are they having all these conditions satisfied, the four criteria? So a disposal group can exceptionally be classified as held for sale after a period of 12 months also. This is an exceptional case, okay? That means disposal group means here we are talking about subsidiary. So here, is it a subsidiary? Again, let's... Yes, they have sold the shares in the subsidiary within a year. So it's a subsidiary only. not an asset. Okay. So here, exception cases, even after 12 months, it can still be classified as held for sale if certain criteria are met. What are those criteria? Such as circumstances arising that were previously considered unlikely. Suddenly, circumstance changed, which you couldn't predict last year. It was unlikely that it will happen, but it happened. In that condition, even if it's after 12 months, the sale is taking place, still it will be held for sale, and which prevented the sale from occurring. Conditions which came, you couldn't predict those conditions, okay, because these conditions prevented that sale from occurring in the 12 months, okay. That's why it happened after 12 months, but still it will be classified as held for sale. But this case is exceptional, and you have to make sure in your answer, in your case, is it an exceptional case or not, okay. So this case talks about whether the subsidiary meet the criteria to be held for sale or not. So Tiles made certain organizational change during this year, which resulted in additional activities being transferred to subsidiary. Correct? This confirms that the subsidiary was not available for sale in its present condition as at the point of classification. When you told that it's going to be classified as held for sale at that condition, it is not available for sale in its present condition. Because first of all, they are making organizational change and additional activities have been transferred to the subsidiary. Next, furthermore, the shareholders' authorization to sell the subsidiary was only granted for 1 year, and there is no indication that this has been extended, that this will be extended only for 1 year. So this places doubt also on whether the sale of the subsidiary is highly probable, whether it will take place or not. And finally, the subsidiary should therefore be treated as what? Correct treatment you are telling now. It should be treated as a continuing operation in the financial statements for both these years, okay? This means that the subsidiary's loss will no longer be. What does this mean? What is the impact? It means that the subsidiary's loss will no longer be presented as a separate line because it is continuing. So together you can present that loss. You don't have to present it separately. Only if it's discontinued operation, then only the profit and loss from that discontinued operation you show as a separate line item within the statement of profit or loss. And it will be instead held where correct treatment is, it will be held within profit from continuing operations. So some of the assets and the liabilities of the subsidiary will also need to be reclassified from current to non-current now, because you're not selling now. When you're selling, only it comes from non-current to current. Now you're not selling, so some of it might will go from current to non-current. Now we are coming to the third issue, which is disclosure of bonus. Okay, we exactly don't know which standard to apply now, looking at the word bonus disclosure, but if we read it, you will understand somewhat what is it about. So during the year ended 30th April 2005, the directors of Tiles acquired large performance-related bonuses. They were available in the year ended 30th April 2006. All accounting entries relating to these bonuses have been posted correctly, but the finance director has omitted the expense from the current year's director's remuneration. Expense from the, it's an expense, no? The bonus the company has to pay. So company will record it as an expense. So the finance director has omitted the expense from the current year's director's remuneration disclosure note. They're not disclosing it anymore. So she believes that disclosure of this information would lead to negative press about Tiles and would cause employee and shareholder dissatisfaction, both of which may depress Tiles' share price. So the finance director has therefore justified non-disclosure on the grounds that it will maximize shareholder wealth. When it comes to disclosure, okay, so with standard it is IS 24. IS 24. Related party disclosure. Whether there's a related party or not, soon we'll see. So most of you might be shocked now because there is nothing about related party, no involvement. How related party? So make sure that you explain why the bonus needs to be disclosed. This is recommended of IS 24, related party disclosure. Okay, for that we'll see why. So according to IS 24, now you are writing according to what do you need to write exactly from that standard? Key management personnel. Who is a member of a key management personnel? Finance director. Okay, this is whose remuneration you are not disclosing. Director's remuneration. Director is at the key level. It's a key level person, key management, right? So you need to disclose it. If you don't disclose it, it comes under IS 24, right? That's why we are starting with what? Under IS 24, we are discussing about the key management personnel because he's a key management personnel. He's a member of a key management personnel. So if anyone is a member of a key management personnel, is related to the reporting entity. Now do you know why we have used IS 24? Did you understand? At first instance, it might look like that there is no standard specific for this part. You might be confusing. How IS 24? Because whoever is a member of a key management personnel, he or she is related to the reporting entity. This is why related party disclosure. So the standard explicitly states that directors are, they told that they are the key management personnel, the directors. That's why you have to disclose their remuneration and all. So IS 24 states that entities must disclose all compensation paid or payable to the members of the key management personnel, directors, whatever their compensation, you have to disclose it. Therefore, TILES must disclose the bonuses payable to the director. Correct treatment. Now we are coming to the ethical and the professional issues. Earlier, these two things were separate, okay, this in the past paper. But in the recent sitting from September 2021 onwards, these two are same thing, okay? Ethical and professional issues is one. They are combined and taken as one only. They are not separated. But because this is a past paper, so you will see separate ethical and professional issues they write. So now let us read the ethical. For that, we don't have to read the scenario because we have already read it while we were answering. But remember the three scenarios. First and the last one, they didn't disclose the bonus. Second one, it was regarding what? Discontinued operation. It was supposed to be continued, but they discontinued it. Then we have temporary deferred tax asset, which should not be recognized. So relating to this, you have to write your ethics answer. Okay. Now, as I told you, this copy paste in question number 22 also, please check when I was going through the ethics answer. I told this first paragraph copy pasted. You can write exactly as it is. Okay, this will be repeated in all the ethical answers. You don't have to think too much. You can just reuse this one. That users such as shareholders and employees, they rely on the accountants to faithfully represent the performance and the position of the entity. So accountants are professional who are bestowed with status and are trusted. To ensure that this trust is not broken, accountants are bound by a code of ethics and conduct. Make sure you write this in the answer. ACCA code sets out the importance of fundamental principles of this five: confidentiality, objectivity, professional behavior, integrity, and professional competence and due care. Okay. If you don't, okay, see, if you don't write all these five, still you will get marks. Okay. But you have to specifically refer the ethic answer to the scenario. Otherwise, you will not get the two professional marks. Remember, if you're just writing general ethical answer, you will not get. By saying he or she is not ethical, they are not following this, they are breaking. No. Refer to the exact scenario. So the three things, accounting issues, either you can write in one paragraph or three separate paragraphs. Okay, if you have so much to write, I would say write in three separate paragraphs. If you don't have so much to write, just say you can write in one or two lines. I would say then write together, all the three in one paragraph. So now, a faithful representation necessitates compliance with accounting standards, including what? In this, it is IS 12, deferred tax, IFRS 5 and IS 24. These were the three standards that you need to apply. But they didn't follow this. The debtors have not followed the rules in these accounting standards, and thus performance and position of title has been misrepresented. You see, it's not ethical. Why? They didn't comply with the standard. So it has been misrepresented, their performance as well as the position. Now we are coming to the deferred tax asset. So for example, the recognition of deferred tax asset, what happened? When you recognize it, it boosted the profit for the year. Because we assume there will be taxable profit in the future, that's why we minimize the losses against it. Okay, hence we recognize the deferred tax asset. So incorrect classification of the subsidiary, the second issue, incorrect classification of subsidiary as a discontinued operation means that the loss is presented separately from the rest of the TILES operation. Because for discontinued operation, guys, loss or profit we always present separately. We don't include it with the continuing operation. That's why that loss now goes separately, because you didn't. It was an incorrect classification. It is a continuing. So because of this, and therefore it is likely to be seen by the users as a non-recurring item. See, whenever something is given separate from the profit and loss, separate line item, people think that it's non-recurring. That means it is a one-off item. That's why they don't pay so much of attention to this, which might impact your performance in the future, right? So it's a misrepresentation of your performance. So such measures suggest that directors lack integrity and objectivity. I told you, you have to refer to the out of the 5 ethical principles. You have to refer exactly this situation is breaching which one. It is a lack of integrity. He's not being honest in what he's doing, and also objectivity. He's not being independent. He has a financial interest there in the company to boost up the profit. So he's not being objective. Just see how it does not affect the other 3 fundamental ethical principles: confidentiality, professional behavior, and professional competence and duty. It only affect integrity and objectivity. Every scenario is different, and in every scenario, which ethical principle it might impact is different. Okay, but mostly trend. I have seen the trend. It is integrity and objectivity. This two always is there. It does not mean that in your answer you will write it because I said always. You have to read the case study and see also whether it is applicable or not. Now we are coming to the related party disclosure. This is a bit separate from the other two. The reason is because earlier in the past paper there has been change in this also in the new syllabus. That means from September 2021 up to June 2022. Related party disclosure will not be asked as an ethical issue any longer. It can be asked it could be asked as an other accounting issues or the reporting issues. Like how other issues are asked, this also will be there now. Specifically for ethical, it might not come, but before earlier, this part was specifically relating to ethical issue. That's why there's a whole paragraph on this on ethical side, related party disclosure. Okay, so that's the only change in IS 24. After that, there is no other change. Okay, whatever you have studied under related party disclosure IS 24, you still have to study the same thing under the new syllabus also. So related party disclosures will impact what the user's perception of an entity's past and future performance as well as the success or failure of those who govern it. After all excessive directors' remuneration, it is unlikely to be in the best interest of the shareholders' wealth. They told why they are not disclosing it because it will maximize shareholders' wealth. But is it correct to say that? No, because you can hide excessive director remuneration. If you don't disclose, how will the shareholders know what is your remuneration? You can take excessive remuneration also because no one is there to check. You're not disclosing it. So excessive directors remuneration is not in the favor of shareholder. Remember, because it will go from your pocket, your company. Excessive directors remuneration means shareholders will not receive dividend. They will receive less and less dividend. So where is the shareholders' wealth increasing? See, it is not in the best interest of shareholders' wealth. Excessive directors remuneration. That's why this is an ethical issue. And is at odd with the directors to achieve also responsibilities. That means they are not taking good care of the resources that they have been provided with. The responsibilities that they should carry out to look after the resources given by the shareholders, but they are not doing it. Why? They are wasting the resources. They are using excessive data remuneration they are taking. So stewardship responsibilities also they are not following. And also it's not in the line with the shareholders' wealth also. The excessive remuneration. Okay, so director pay is an issue that the shareholders have explicitly raised concerns about it and would therefore seem that Tiles is trying to actively mislead its investors. It looks like they're trying it. Okay, so this is in a clear breach of ethical code if you're doing it. Moreover, in some jurisdictions, disclosure of directors' remuneration is a legal requirement. Yes, it's a legal thing. You have to, by the law, you have to disclose. And so Tiles could also be breaching company law as well, if it's not breaching. Now, finally, you are giving a conclusion. Therefore, despite the finite data's claim about the impact on the shareholders' wealth, that they told that, okay, don't disclose, shareholders' wealth will increase. But even after that claim, she has a responsibility as a member of the accountancy profession to present the information in a fair and an honest fashion. You have to present it. It has to be fair, it has to be honest. Now we are coming to the marking scheme. We are done with question number 23. So if you see, deferred tax asset is 1 mark, discontinued is 1 mark per point, related party and ethical 1 mark per point. How are they dividing it? You see here it is 5 marks. 2 additional marks, usually it's 3 marks. Okay, that's what we have done. I have divided, right? Equally I have told 3 marks. But why 5 marks? 2 additional marks for explaining the evidences. That evidences are not in line. 2 marks extra there. Then coming to the discontinued operation. 1 mark extra there for discontinued operation. Okay, because we have many things to say. For example, the criteria of IFRS 5 were there. That's why that 1 mark additional was there. Now, if you ask me, how do I know which mark is for what? How do you identify which mark is for? See, that comes from experience, okay? It is my experience. I have went through so many past papers. I have seen it. So now if you try to do for the first time that this will go for this will, you will not be able to do it. Trust me. It comes with practice. You do lots of questions, it will automatically come to you. You will exactly know, okay, this is where the points are like this. Okay. You will be able to know it. Trust me. So no one can help you there to exactly tell you that this is, it will come from your side. You will know it when the right time comes. Okay. That's why lots of practicing papers is very important to know these things, how much I have to write. Once you do many questions, you will know the pattern that for this many marks I have to exactly write this many points. Okay. Related part is 2 marks because related part is not much to talk about. If you see, it's just very short. Number one is that you're talking that this is a related party, 1 mark for that. Another mark for saying that they have to disclose because key management personnel. So 2 marks. So this should give you a guideline on deciding how much I have to write. If you have much to write means more points will be there. Okay. I told you equally. But when you are equaling also 333, somewhere it will be +1 or +2, somewhere it will be -1 or -2. Okay, don't forget. Exactly it cannot be 333 because some areas we need to write more with calculation, some area you are writing less. For example, related party we are just writing 2 points. We are writing less, so -1 from here. That means 2 marks for here out of the 6 marks because 6 for ethical and 6 for this one, no? Sorry, 9 for this and 9 for this. That's how we are getting the 18 marks. 9 for ethical. Forget about the ethical. I'm not worried about the ethical. I'm worried about this one. Accounting issues now. Okay. So now, discontinued operation, add 1 mark because criteria of IFRS 5. Okay. Then discontinued +2 because we had talked about evidences and all. Right. More and more in that one only we talked. So this will give you a guideline. But before actually writing the answer or seeing the answer, you have to decide this strategy. This strategy you have to build before writing. That this many points I'm going to write. 3 + 2, that means 5 points I'm going to write under deferred tax asset. Discontinued operation 4 marks, that means I'm going to write 4 points. Related party 2, so 2. Ethical if is the balance, okay? 2 is here, so if you out of 20, if you take this and 2, the balance is 7. That professional marks 7 also, how are you going to remember 3 marks you'll be getting for the accounting issues that you have discussed, relating it to the accounting issues, specific to the accounting issues 3 marks, and the balance 4 marks for writing the actions and all, what they need to do and all. Okay. And rest 2 marks is for the structure. Okay. And rest all. So this 4 marks not only actions, it also covers your what are the ethical principles that are being breached and all. It covers everything. Okay. Maybe 2 marks for the actions and 2 marks for the ethical that is being breached. And these 2 professional marks is for following the structure, writing appropriate recommendations and all those things. Okay. So that's it for question number 23. See you in question number 24.